market breakdown, and as you guys have voted in the community tab, you do wanted to see a multiple breakdown. So we are going to take a look at GBP USD, USDCHF, the Nasdaq 100, the Dow Jones, as well as silver and gold. If you're new here, welcome, and a sub would be appreciated as I provide valuable educational content. If you enjoy the video, please leave a thumbs up, as it really helps the channel out also. Now, before we get started with the technical analysis, it's very important for us to understand what fundamental data had come through last week that is going to carry into the new week. Now, one of the most important things, obviously, is we know that we had the NFP that came through, blowing people's minds. Not only had the average hourly earnings increased, but the job report came out more than double than what the investor sentiment or the Dow Jones had predicted. Unemployment rate also came down back to pre-pandemic levels there as well. Now, that is a very good thing for the dollar index. Now, it's funny that weaker than expected growth in NFP or even a bad loss of jobs can have an opposite effect, dampening US economy prospects and see a weakening in the US dollar and US stocks. This can also trigger a rise in the price of gold should investors seek the precious metal as a safe haven. Now, if that's basically how the NFP would affect the stock market. Now, it's funny to say that because if that is how the NFP operates, right? So if the NFP brings through a negative data, that means that the dollar index would have weakened and the stock market would have weakened there as well. But the data was positive, which should have moved the Dow Jones or the stock market to the upside, as well as the dollar index. But the dollar index gained so much momentum on that one candle when the NFP opened. But the stock market just didn't get anything from it. The stock market was so negative, and I'll explain to you guys exactly why that was. But before I did that, it's important to understand why that had happened. Now, we are going to just, like I said, we had some very positive data last week for the dollar index, so we can expect the index to increase in value, meaning that pairs like GBP USD should decrease in value, the USDCHF should see an increase in value, the Nasdaq probably sought a momentum to the upside to clear that liquidity, the Dow Jones there as well, gold and silver. They see a negative correlation because gold and silver futures are quoted in dollars and B, and it's also a monetary which could also be used to replace the dollar index. So when the dollar index is no longer credible, there will be a high demand for gold and silver when the demand for the dollar index inclines, and vice versa. So as we expect the dollar index to increase in value, we then automatically can expect the gold and silver to decrease in value because there's a higher demand for the dollar, and as a result of that, there's less of a demand for gold and silver, so the prices of that tend to decrease there as well. Now, this is an article by CNBC. Payrolls increased 528,000 in July. Not much better than expected, but phenomenal work out there as well. Now, Powell had always been speaking about the strong labor market. It says the NFP rose 528,000, wage growth were up 5.2%, and now traders are pricing a likelihood of a 0.75% basis hike because it was mentioned that we could potentially see a 0.50 basis point hike there as well. Here we can see it says the market initially reacted negatively to the report as traders anticipated a stronger counter move from the Federal Reserve, and I'll explain to you guys what that means. They're looking to cool down the economy, and particularly in a heated labor market. However, the Dow Jones ended day positive with 75 points. I won't call that 75 points for a market that has been trading sideways for the lateral part of last week. So nothing to see there, my good friends. So I'm going to move that aside. Next up, this is the report from CNBC. Nasdaq, Dow Jones fell, took a massive dip, and the basic reason for that is it's just one of that things. And it says here Friday's job report is a crucial one, as it's one of the two central banks will see before he decides how much to raise its rates as its September meeting. Indeed, traders are already betting on a tougher stance from the Fed. Policymakers will have another job report and two, and this is basically what we can anticipate moving forward there as well. Now, if you're sitting there and you're wondering, exactly. Exactly why the Nasdaq, went acted negatively towards this. It's because that investors thought that the job report would come through negative. Now, the reason why they thought the job report would come through negative, because if it did come through negative, the Federal Reserve would have then hiked interest rates by 0.50 basis point, which inevitably would have sent the stock market to the upside. But because the job report came through so phenomenal, as we've saw in the previous article, that basically means that the Federal Reserve is now highly expected to hike interest rates even higher, meaning that the stock market is going to plummet to the downside even further, because investors were betting on a poor labor market, because in order to cool the economy down, they were expecting that the job report was going to look bad, but it didn't. It looked much better than what they anticipated. And as a result of that, the stock market went to move to the downside. This is the target rate probabilities for next month, and we can see here between July, the 50 basis point was sitting at 79, call it a 78%, and then the towards the end of the month there was a 72% probability, and then we also saw the probability of a 75 basis point was quite low over here. And after the NFP job reports came out, we can see here the probabilities actually shifted, and the probability of a 0.75% basis point is now higher than what it was before the NFP data were released. So the Federal Reserve is highly likely to now hike interest rates by the 0.75 basis point, which is not good for stock markets, but it's overall good for the dollar index there as well, because we know that investors like to invest their money in currencies that has got a higher interest rate, because it means better returns for them in the long term as well. Now, with that out of the way, my good friends, let's get into the technical analysis. Now, if you start on the monthly time frame, now we are going to look at the GBP USD. If you start on the monthly time frame, firstly, now I've spoken about this currency for quite some time, and we can once again see that the GBP USD is sitting at a very strong level of support, but that does not mean the market doesn't have room to move even further, to go and pick up some more sells there on the downside there as well. Market also printed recent structure here, acted as a level of support. Support got broken. We can definitely expect a short correction before that continuation once again to the downside. If we go on the weekly time frame, what do we see? Now, from a weekly perspective, we can see how the market is currently trading at this level over here. This level acted as a level of support. Market broke below that, came back to test it as resistance. So we do now have a contradiction between the monthly and the weekly. On the weekly, we are bearish. On the monthly, we are bullish. But this would be the level at which we can be looking to sell the market from. Now, if you drop down on the daily time frame, what do we have here? Now, on the daily time frame, we can see how the market had just completed this head and shoulders pattern. Now, after head and shoulders pattern, you obviously expect the market to pull back to this level over here, but that's a whole complex story, and I'm not going to confuse you guys with that. I'm going to give you the simplest way to approach this. So this level over here acted as a strong level of support, and once support gets broken, it becomes resistance. You can also see how the market is currently testing this level of resistance that is broken, and it's testing it as a level of support. Going into next week, we can expect GBP to get slightly stronger in the long term, in the short term, and then from there we could potentially then start looking for selling opportunities. So also keep in mind that the interest rate for GBP has also been hiked, but the dollar will always remain the dominating pair between the two. So this is how I'm going to be approaching this situation. So we are going to there's some buying opportunities slightly to the upside, and then we can start looking at doing it to the downside once again. Next up, we do have the dollar index here against the Swiss franc over here. Now we can see from a monthly perspective, and I've always spoken about this pair also, we have this market that had broken above this very strong level of resistance, and we can see the market came back to test it as support. We also have this massive impulse. After an impulse, you expect a correction, and if you take your Fibonacci from the low to the high, you can see the market tested and rejected the 0.382. Now, if you take our Fibonacci on this correction level over here, and we use the minus 27 as our take profit level, you can see how it lines up perfectly with that previous high that the market had created, that we can expect the market to pull back to first. On the weekly time frame, we can see last week's close, the market had broken above this level over here. This level acted as a strong level of support. The market broke below support, came to test it as resistance. Resistance then got broken. All of that resistance is now acting once again exactly on that support. Now, next up, we do have the daily time frame here. Now, from a daily perspective, we can see the market is currently trading at the strong level, not trading, but had broken above the strong level of support. The resistance broke above resistance. We can see now all of this resistance is once again acting as a level of support. Once again, going into next week, we would be, it would be very important for us to be, reactive and not predictive. The best way I would approach this is to wait for the market to pull back slightly higher than on the retest, then start looking for that buying opportunities over here as well. Sorry about that, my good friends. And then look for that buying opportunities there. And this would be a long buy if you are a swing trader to that level over here. But as retail traders, I know most of you probably get out at this level, which is okay. It's each to their own there. Next up, we do have the Nasdaq 100. Now, the Nasdaq on the monthly time frame, because we're anticipating that high interest rate hike, there is a slight move to the upside for the stock market before the move to the downside on the monthly time frame. We can see the market is now currently trading above the structural level that we were anticipating the market to continue lower to. The market printed this massive impulse. So after an impulse, we got the correction. Now, to measure that correction, all we need to do is take our Fibonacci from the high to the low of the impulse. Then I would expect the market to pull back to the 61.8 first before that continuation to the downside there as well. Now, here on the weekly time frame, what do we see? Now, from a weekly perspective, we can see how the market had last week had broken above the strong level of resistance over here. Printed this once again W formation, but again, broken above this level of resistance. Again, there's just a short move up, and then we can expect the market to start that U-turn there once again. Here on the daily time frame, if you remembered, I spoke about this market when it was there, and I said we can expect a pullback before that continuation to the upside. Now, where would I be looking at buying this market? It would probably not be any higher than this level over here. We have this impulse and that correction, and if we take a Fibonacci from the low to the high over here, you can see we are at 0.50% pullback. And if you take your Fibonacci on this one candle, you can see why I'm anticipating, because we do have the take profit level lining up perfectly with our previous level of resistance there as well. So this is how I will be approaching the situation. I will be continuing to hold the buys that I've entered there. And I know most people took a sell, and then it was just a crazy day on Friday, but okay, I'll probably just wait for that pullback over there, and then from there I'll probably start monitoring price action and then start looking for that pullback in the market there as well. The Dow Jones, I'm not gonna run around too long with this story, but the Dow Jones also has got room for, let me just close this. The Dow Jones also has room to clear some liquidity over here to the upside or there. The Dow Jones is currently stuck within a consolidation, as you can see. That's why I said if you go into lower time frames, you'll notice this level over here. Let me just go on the 4-hour time frame for you guys very quickly. So if you look on the 4-hour time frame, you can see the Dow Jones was trading sideways last week. And the funny thing about the market trading sideways is that you have people like CNBC comes out that says, oh, the market had rallied 75 points. Oh, the market's down 75 points. Oh, the market's up 75 points. And that's basically how the news is going to go when the market is consolidating and people are running around like chickens with no heads. So in any case, because we are in a consolidation market, we cannot ignore this impulse correction pattern there as well. Take our Fibonacci there from the low to the high. We are going to have a 0.382 pullback. Yeah, so the market never came back to hit. So that's going to be our target, short-term target level over there. So once again, it would probably be okay to just start looking for those buys. Alternatively, the market could first do that, or again, or the market could just break above that level of resistance, test it as support, and then start that continuation to the upside. But because excuse me, the gap between these levels are, is quite short, I would probably just do that. Again, I would also just monitor the price if we do break below this, but that is just too much options. So this is basically where I'm going to, if the market momentum shifts, I'll be sure to give you guys an update on that as well. Next up, we do have gold. Now, gold is a precious metal over here. Now, once again, we can see here, gold here on the monthly time frame. Gold had broken, and if you remember, I spoke about this the last time. Gold broken below the strong level of resistance, support. Support got broken, came back to test it as resistance. Again, gold has got more, room to clear. Not even till there, because gold has just been, well, it's time for gold to maybe start giving up these gains, because it's holding on longer to a person who's got, But in any case, so next up we do have this massive impulse. So after an impulse, you expect a correction. You take your Fibonacci. We got a 50% pullback, which is normally expected after such a massive impulse. So we can see here that the market had broken below the strong level of, again, a short-term move to the upside before the continuation to the downside. Here on the daily time frame, what do we see? Now, from a daily perspective, the market is still in bullish structure, and we could potentially see the start of a consolidation phase, because you can see, as we've identified from a weekly perspective, we expect the dollar index to decrease in value to pull back the liquidity that it had moved to the upside based off the NFP data that came through positive. So we could potentially see gold just go up, then continue this move to the downside there as well, because markets don't just move in the direction that it's supposed to. It needs liquidity in order to move to the downside. If gold, however, does close below this level on Monday, then on the retest, I will then just shift my momentum. In doing so, we would then get this head and shoulders pattern, which is considered a bearish pattern from a technical perspective. Two places to sell is at that high or the break of this level here as well. Next up, we do have silver. Silver is also negatively correlated with the dollar index. Then we are going to approach this situation similar over here. Silver's been trading sideways for the lateral part. Once again, we're going to approach this the same way. Clear break below this level on the retest. Apply the rules of the strategy that you use. Alternatively, and I always say this, these are the best places to get into the market, to start looking for those selling opportunities over there. So I would be looking to trade this either way, and that is how I will be approaching the situation there as well. I want to say thank you so much for your time. Thank you for the support. And as always, my good friends, cheers for years.